Hello, everyone, and welcome to our next presentation. We will be getting started in just a few minutes, but we thank you so much for joining us. Hey, JC, can you hear me okay?
I can, loud and clear. Can you see me okay?
I can see you. Yes, here, let me stop sharing my screen so we can see you better. We are live to the audience right now, okay?
Cool. I'm
Awesome.
facing my desk. Look at this. Cool, right?
That's that. Yeah, very cool.
So fancy. I'm very fancy.
Awesome, awesome. Cool. Are you sharing your screen or are we just watching you today?
My charts are way prettier than I am.
If you say so.
So it's in everyone's best interest that we don't focus on me and we focus on price action.
Awesome, love it. Well, go ahead and
Um,
share your screen. I'll make sure we can see it okay.
right, on my way, on my way.
hmm
Getting good at this over time.
I think we all have.
I know. Share screen, advanced. Look at that. Look at that. If I do this.
Right, I
How's
see
that
a
look?
port. There we go. Yep, perfect.
Nice.
Awesome. Well, if you are ready, let me give you a little introduction and let everybody know who you are, and then I can let you take it from there. Sound good?
Sweet.
Fantastic. Do you want to take some questions at the end?
If we have time, I'm happy to, yeah.
Okay, great. So, to everyone watching, please post any questions you have right here in the live chat, and I will collect them and we will ask JC at the end if we have time.
Cool.
All right. Good morning, everyone, and welcome to the Money Show Virtual Expo. We've had a few great presentations already this morning, and joining us next is JC Parets, the founder of All Star Charts. JC is one of the most widely followed technical analysts in the world and is here to discuss how to build winning stock scans. JC, we are so delighted to have you here with us this morning. The floor is yours.
All right. Awesome. And thank you, everybody, for being here. I appreciate you taking the time out of your day. You know, one thing that I always like to say and remind folks is that, listen, I think it was a Jay-Z. He said, you could be anywhere in the world, but you're here with me. And I appreciate that. And I think one of the things I'm moving here, one of the things that I appreciate is how for close to 2 decades, I've really gone out of my way to learn as much as possible. Listening to my predecessors, my colleagues that have now, in many cases, become close friends, and that's really cool too. And this is what you guys are doing, right? You're taking time out of your day to learn and get better. And even if my presentation sucks and I can't do anything good for you, the fact that you're going out of your way and you're showing that effort, you're going to win at the end, even if I'm a terrible presenter and I provide no value. Like eventually it's going to come back and you're going to get there. So kudos to you. And I'll try not to be terrible, and I'll try to add value. And I think this is a good value add because we talk a lot about the top-down approach, and we're going to get into that in a minute. And it really boils down to identifying first what type of market environment we're in. Are we in a environment where stocks are going up? Which stocks are going up? Are stocks going down? Which ones are going down faster? Are we in a sideways mess? How do interest rates fit into that? And the currency markets and commodities, right? Are there inflationary signals, deflationary signals? What's going on? That's the first thing we want to do. We want to first identify what type of market environment we're in, and then identify which tools and strategies are going to be best for that particular market environment, rather than just creating some indicator or some magic signal that we're going to force upon the market regardless of the environment. That's stupid, right? We have different tools for different things. Like, you're not going to brush your teeth with a hammer, right? We have a toothbrush for that. And if your wife asks you to hang a picture on the wall, you're not going to go get your toothbrush, right? You're going to go get your hammer and your nail, aren't you? Right? So in real life and in the market, we have different tools for different environments. So that's the top-down approach, first identifying the market. Then we have a bottoms-up approach, is what we're going to talk about here, where we are going to talk about some of our favorite scans. So we do all of this top-down work, and then in addition to that, we supplement that work with our bottoms-up approach, right, where we are building specific scans to find stocks to buy and sell. One of our analysts lives in the Florida Keys, and when you're in the Keys, chances are you probably go fishing every now and again. And the locals know where the best fish are, right? They know where to get the fish. They know where the coral, they know where the wall drops off underwater. Like, they know where the fish are, and that's where they go fishing. So for us, it's the same thing, right? We are locals in the Florida Keys, if you will, and we know where the fish are because we've studied markets forever, and we know what stocks tend to do before they make historic runs. So we build scans to find those specific types of stocks. So today's presentation is essentially about a few different ways, or I'm going to show you a few cool spots down in the Florida Keys to go fishing where the fish like to hang out, right? That's what we're doing today. 4 scans in particular. We're going to talk about the minor leaguers. These are small cap stocks between $1 and $2 billion. Then we're going to look at the 2 to 100 club. These are the stocks we think can be the next $100 billion companies. And we're going to talk about how we find those. Then we're going to talk about the Under the Hood report. These are stocks showing an unusual increase in investor interest, whether it's unusual volume or spike in social media mentions or insider transactions. Chances are it's usually a combination of a few of those things, so we've learned. And then, of course, Young Aristocrats. That's a fan favorite because these are stocks. These are I don't know if you guys have ever heard of the Dividend Aristocrats. These are stocks that have raised their dividends every year for 25 consecutive years. Think Johnson & Johnson, Coca-Cola, Procter & Gamble. We're looking for the Future Aristocrats, stocks that have raised their dividends between 5 and 9 consecutive years. They're called the Challengers, and we're going to talk about that. But first, let's do the top-down work so you can see just how important it is to supplement what we do with the bottoms-up approach, is what this presentation is about. So let me start with the top-down briefly. We're not going to go crazy on the top-down approach, but we're going to get into it. This is classic year 2, guys. Classic year 2. I don't care who you are, technical analyst, fundamental analyst, economist, maybe you look at the stars and the moons to make your decisions on stocks. Regardless of any of those things, you're not going to argue with me that the last year was a hell of a year for stocks, right? I mean, in fact, depending on what index you're looking at, I mean, you can make a strong argument that we had a 52-week period from March to March or to April, or really from March to March, that was the best 52-week period for stocks in 75 years. Hell of a year. Great. So that's year 1. Now, when we study former year 1s, we tend to see that after that initial thrust off the lows, year 2 tends to be not like year 1. Tends to be very choppy. You guys remember 2009. I remember very well, of course. I remember very well. And, we had a killer thrust off the lows in March of 2009. And then what happened in 2010? Chop, 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 right? Choppy mess. Go back after the tech bubble burst, right? Ultimately, we found that low in 2003, and we really ripped into 2004 in that first year thrust off of those lows. And what happened after that? Chop, 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 right? Classic year 2 behavior, just getting chopped up. I was born in 1982, and the stock market started going up from there. Maybe it's a coincidence, maybe not, but that's what happened. And after that initial thrust in 1982 into 83, what happened after that in late 83 and early 84? Chop, 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 chop. Right? After that initial thrust in the beginning of a new bull market, year two was a mess. And then go back even further after the 1974 low, epic low in the 70s, killer year one. And then what happened after that? Chop, 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 right? These are classic year two. And you're going to argue with me that the last 52 weeks wasn't a huge thrust off of an important low, right? You're not going to argue with me on that. So what should we expect in year two? We should expect exactly what's going on here. Chop, 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 messy markets. The money coming out of large cap growth is quite obvious. Just to be clear, it's not anything new. This has been happening since Labor Day of last year. So we're going on 3 quarters of growth underperformance. And what's interesting is that more recently, after March and into April, we got a bounce on a relative basis in growth stocks. What are the growth stocks? Obviously, think NASDAQ, think tech, communications, internet, discretionary, think growth, right? So we got that bounce on a relative basis, ran into all that former support, and we fell apart again. And we expected that to happen because what they teach you in technical analysis kindergarten on the second day is that former support turns into resistance, and that's exactly what happened. And then what you also notice is that when you go down the cap scale, the bounce in the small cap growth stocks relative to value was much more muted, right? Much more muted. So this was telling you that this bounce is probably going to roll over, and that's exactly what's taking place, right? And we're getting new lows as we speak. Look at technology relative to the rest of the market making new lows. Look at growth stocks relative to the rest of the market making new lows. By the way, these charts were from the weekend. Got even worse yesterday. Meanwhile, look at value stocks, financials making new 52-week relative highs. Look at materials making new multi-year relative highs. These are the value areas of the market, which, by the way, if you go back to 2004, 2005, 2006, this was early on in my career, it wasn't tech and growth that were outperforming. It was the value stocks. It was energy, materials, industrials, financials, international, emerging markets. Those were the areas that were leading early on in my career, right? 2004, 2005, 2006, and we're seeing the same thing now. Meanwhile, we just got a breath thrust in the value stocks. So these are the value stocks making new 63-day highs, highest reading in half a decade. And what do we know about breath thrusts? We know that they tend to occur near the beginning of trends, not near the end of them. And when you look at the new 52-week high list, the New York Stock Exchange Composite had the most new 52-week highs yesterday, like ever, or something ridiculous. But the NASDAQ new highs are nowhere near there. Non-existent. Ghost town in the NASDAQ new highs. Ghost town. Let's remember, in the New York Stock Exchange, you have a lot more value, a lot more international. And in the NASDAQ, you have zero financials, zero materials, zero energy, 2% industrials, zero real estate. Like, there's just no value in the NASDAQ. It's all growth. And you can really see that in the tech versus financials. I mean, when you talk about growth versus value, tech versus financials is the real, that's a big part of that. And if we are below the dot-com bubble highs in tech versus financials, there's a long way down to go. So my suspicion, based on my experience, is that we are not out of the woods for growth investors. In fact, I think things could be about to get much, much worse. So that's why we're short the NASDAQ. We've been short since last week, since Monday. And, it was really new highs in the NASDAQ, and then on a relative basis, just really rolling over compared to the New York Stock Exchange Composite. You had, the new 52-week high list, as we mentioned, is non-existent. The advanced decline line, I didn't bring the advanced decline line with me, but take a look at it. It's pretty gross. So anyway, a lot of reasons: breadth deterioration, momentum deterioration. You see it across the board. So it was a nice risk versus reward to be short the NASDAQ only if we are below 338. That was the level, 338, because these are the former highs from March. So if we're below the March lows, the bet is down, not up. Sideways at best, but probably down. Certainly not up. So we definitely do not want to be long the NASDAQ if we are below 338. Quite the opposite. We want to be short. We still want to be short. By the way, if you're interested in these slides, email info@allstarcharts.com. Make sure to use the password bottoms up. So info@allstarcharts.com, password bottoms up. And then, when you look at the bond market, same thing. High yield bonds tend to outperform treasuries as risk is on. And that's not what's happening now, right? So this is what was happening last January in 2020, which is part of the reason we started getting short stocks and buying bonds in late January, was we were seeing credit spreads widen, right? So when this is going down. That's credit spreads widening. Meanwhile, what else is going on that we haven't seen in a while? Gold's making new highs, right? The first thing things need to do before they can start going up is to stop going down. And, gold making new highs, consumer staples outperforming also, putting in bottoms. These are characteristics of market environments where stocks are not doing well. Not types of things you see when stocks are doing well. So just further evidence, classic year two stuff. So we liked buying gold miners in March. Former resistance in GDX right here around 31. This, if you zoom out, it goes back even further. 31 was resistance. Then we broke out last year, retested, off to the races. Now we're back down to these levels. What does polarity principles teach us? That former resistance turns into support. Here's your breakout, right? So the risk versus reward is very well defined, because if we were below 31, all bets are off. But that's not what happened. We were right, and gold miners ripped. I still think we get back up to the mid-40s in the GDX. Meanwhile, last week we got a nice breath thrust in financials. The most amount of new 52-week highs in a long, long time. And what do we know about breath thrust? They tend to occur near the beginning of bull markets, not near the end of them. And then just look at these tops. Look at Bitcoin on a relative basis to Ethereum. Look at technology on a relative basis to financials. Just very toppy, right? So this is the macro top-down work that we do to help us identify what areas we want to be in. Notice how Ethereum's been working, Bitcoin has not. Financials have been working, technology has not. Like, you can see it in these charts, right? We've been seeing it. You can see Bitcoin's dominance or lack thereof. Bitcoin was over 70% of the crypto market coming into 2021, and now it's closer to 40%. It's really, really interesting underperformance. And you can really see the breakout in Ethereum. I think we get back up to those highs from 2017. Why not? There's no evidence suggesting that it won't get there. So I think Ethereum continues to go higher, particularly relative to Bitcoin. 3,600 is my level. As long as we're above 3,600, you can even give it some room down to 3,500. Understand the beta and the volatility here. But if we're specifically above 3,600, I see no reason not to own this. 5,700 is next for Ethereum. And look at these bases in Monero. I was taught to buy smiley faces and sell the frowny faces, right? So these are the frowny faces. These are things that we want to keep selling. And then we want to be buying smiley faces, big smiley faces, big smiley faces, big smiley faces. So particularly, I want to get the numbers right. So just to be clear. So on the Monero, if we're above 470, we want to be long because that puts us above the 2018 high. So we can only be long these names if we're above the 2018 highs, because if we're not, that is by definition not a breakout, right? We can only bet on a breakout if we're above those former highs. So if we're above in Monero, if we are above 470, we want to be long with a target of 740. If we're below 470, leave it alone. Cardano, same thing, 147 is those former highs. So if we're above 147, I like it long with a target of 340 for those. Now let's get into the scans, right? So that's the top-down approach where, we're identifying what areas we want to be in, what areas we don't, right? All of these things, that's what that helps us, short the NASDAQ, buy weakness on financials, buy weakness on Ethereum, buy the breakout in Cardano and Monero, right? That's top-down. Now, we supplement that by doing our bottoms-up approach. And the first one that we're going to talk about here, we got four that we're going to talk about: the minor leaguers, the under the hood, the 2 to 100 club, and the young aristocrats, right? Those are the ones we're going to talk about. And they're very simple. That's the whole thing that I think you're going to appreciate from this, just how simple they are. So this was the minor leaguers. And what are these? These are $1 to $2 billion companies, because as soon as you go to above $2 billion, you are now a mid-cap. So these are specifically small cap stocks between $1 billion and $2 billion in market capitalization. And we're looking for 30 to 100% moves here. Lately it's been long only, but we're open-minded to shorts as well. So it's technically a long-short scan. And we open it up to all of the industry groups. So we'll get into the 2 to 100 club in a minute, where we're only in specific industry groups that can grow to 100 billion. Just to get from 1 billion to 2 billion, we're in the camp that any company in any sector has the potential to do that. So you'll see a lot of banks and like tools and accessories, resorts, grocery stores. I mean, you'll find anything and everything in this scan. And then we're sorting by proximity to new all-time highs, because with the small caps below the February highs and underperforming or just not doing well, we want to identify the ones that are doing well, the ones that are holding up the best. That's called relative strength. So this scan is from last week, so I just want to make sure. I want to double check how close we are to certain levels. So we're going to go one by one. So this is Oxford Industries. We only want to be long if it's above 97, and right now it is not. Just to be clear, so we are going to be patient in this one. We only want to be long if we're above 97. If we're not, we leave it alone. Right? It's really that simple. I don't think there's really any reason to complicate things. There's very well-defined overhead supply, and if we're not above that, we can't own it. So 97, we want to buy a breakout above that with a target of 138. And what I wanted to do was kind of show you exactly what they do. So it's a $1.6 billion apparel manufacturing company, Oxford Industries. And again, just big base. So if it's below 97, leave it alone. If it's above, we like it long with a target of 138. Now, moving right on to Enpro. Enpro Industries, NPO. This is a $1.9 billion industrial technology conglomerate. It's a global name all over the world, and 95 is the level there. So we're looking for a breakout above 95. If it's below 95, we want to leave it alone. If it's above 95, I like it long. So right now we're around 92.5. So, be patient with some of these. The market's been under pressure. I don't think there's really any rush. But if it's above 95, I like it long with a target of 134. All right, moving right along to Tenant. So this is the industrial sector as well. It's a $1.5 billion floor cleaning equipment manufacturer. So they build stuff for people to clean floors. That's cool. $1.5 billion company coming out of the minor leaguers. Again, we are scouting, for you baseball fans, we're essentially scouting the farm system. For the names that are going to get called up to the mids, if you will, above $2 billion. So this is Tenant. So this is TNC. As we speak, it's just below 83, which is fine because we only want to be long if it's above 86. So that's the resistance in 2018, 2019 last year, and then this year, right? So we haven't gotten above that. I like how it's breaking out on a relative basis. So 86 is the level there. If we break out above 86, let's do it, baby. Let's get involved on the long side. And then this is a really interesting one. This is one of my personal favorites. This is Preferred Bank, PFBC. This is a mortgage lender. It's still below our level of 70. So if it's below 70, leave it alone. I only like this long if it's above 70 because that puts us above the 2018 highs. And just to be clear, it is a $1 billion market cap. So it just squeezed into the into our scan. And look at the proximity to new highs. So 70 bucks is the level there. If you see this baby with a 70 handle, I like it long all day with a target of 100, that classic $100 roll. I don't know if you're familiar with the $100 roll, but basically if it gets to 90, it's probably going to 100. And then the old saying after that is if it gets to 100, it's probably going to 110. But our target is 100. Let's stay disciplined, right? All right. So let's talk about the 2 to 100 club. So now these small caps have graduated to mid caps. Now we're looking specifically for companies between $2 billion and $35 billion. But in this case, we're being much more picky with the industry group because we're looking for the next $100 billion stock. And chances are a utility stock is probably not going to go from $2 billion to $100 billion, right? Let's be serious. So you're going to find names like medical equipment and software and semiconductors and direct-to-consumer internet retail, that sort of thing, right? Just, what you'd think. Solar, right? Cloud computing. So how did this scan come up? I was hanging out with my friend Howard Lindsay, he's a venture capitalist, and, we're talking about it. He's like, JC, we need to find the next $100 billion companies. I'm like, hell yeah, we do. How do we do that? And so we put our heads together, worked with the team, ran a lot of numbers, and, we identified specific industry groups that can do that. We're looking for $2 billion to $35 billion. I feel like we make exceptions. The other day we bought a $50 billion. Ideally $2 billion to $30 billion to give us plenty of room to get to $100 billion. And, we've created it in a way where it's almost impossible for the next $100 billion stock to not come from this list, right? And that's really the point, to help us find that. So let's talk about a few of these names. So here we're looking at Endava, DAVA. So this is from last week. So I just want to pull this up. So this is DAVA. So DAVA, right now it's around 87.5. So it's still below our level. We only want to be long if it's above 89. right? And DAVA is a $4.5 billion, so this is a mid-cap stock, $4.5 billion UK-based software company. I like the relative strength. Take a look at that relative strength. And I like a breakout. So when you see this baby above 89, I like it long with a target of 130. 130 is next for DAVA. Let's move right along to Fortive. Fortive, am I saying that right? FTV Fortive? I feel like somebody who knows is like, no, JC, it's not how you pronounce it. I'm less about the pronunciations and more about, favorable risk versus reward opportunities, right? So this one in particular, FTV is a $25 billion company. It's in the scientific instruments industry, and it specializes in industrial products and solutions for testing and measurement. Sounds very fancy. For me, I'm more interested in this monster base, right? I was taught to buy the smiley faces and sell the frowny faces. So look at this base, keeping this one on your radar. What's happening now, sometimes in strong bull markets, if I were giving this presentation, there'd be a lot more opportunities where the stocks are above our resistance levels, and it's like, go dive in and buy them right away. But we're just not in that environment. So these are the names that we want to keep on our radar and then set our alerts so that we're alerted when these things do break out, and that's when we buy them. And you'll notice what you'll find is you're going to find a lot of them breaking out at the same time, and that's actually an indicator that the market's getting stronger, right? So think of it like that. So don't hate me because a lot of these stocks are below their overhead supply. Just be aware that's just the market environment we're in. And again, if I were giving this presentation a year ago or 6 months ago, chances are a lot of these names would be above their resistance levels because we're in a bull market and stocks are going up and breakouts are happening. That's just not what's happening right now, right? So just don't hold that against me. It's just a function of the environment, right? I hope that makes sense to you guys. Which is why we're shorting the NASDAQ, which is why we're buying staples and gold and, right, bonds, right? It's that sort of thing. All right. So, of the 2 to 100 club, let's talk about this. So, in the 2 to 100 club, I really like this name, Globe. So, this is Globant. And Globant is a company in Luxembourg. It's a mid-cap software stock, GLOB. And stock right now is around $200, so it's well below our risk level. So there's just no reason to buy this unless we're above 235. So keep an eye on this one, 235. We want to buy a breakout above that level. This one coming from the 2 to 100 club. And of course, WePro. This is a favorite of mine from India. So WIT, this has been, we do a lot of work in India. I love visiting India. I have a lot of friends in India. I'm Cuban, by the way. I have no Indian heritage whatsoever. I just really like the food. I really like the people. And I really like the charts. And that's 3 for 3 as far as I'm concerned. So WePro, this is a software services and solutions firm, which is interesting and just long-term downtrend. Breaking out of a major base. $6.40 is the level there. We're well above that. So if the market remains under pressure and you start seeing this thing closer down to 640, we want to be buying that dip, right? We want to be buying that weakness with a target of 1030. All right, guys, moving right along. This is the Young Aristocrats list. This is a fan favorite. These are stocks that we think could be the future aristocrats that have raised their dividends every year between 5 and 9 consecutive years. You can see the years here. You can see their payout ratio, their dividend yield, the latest increase, et cetera, et cetera. So these are names that, quote unquote, pay us while we make money. So WTS, Watts Water Technology. This is definitely an interesting one because it's in a solid uptrend, continues to raise its dividend. We like all of those things, right? Those are the types of names that we want to look for. Let me just pull this up quick. So WTS, we are talking about a water utility stock, as a matter of fact. WTS. Right now it's at 137. So if it's above 136, which is right now it's holding that, we only want to be long if it's above 136 with a target of 210. So it's below 136, leave it alone. Above 136, I like it long. It's above that currently with a target of 210. Northern Trust, NTRS. This is a very interesting one. NTRS. Currently, it is right around 118. NTRS is a large cap regional bank, or a super regional, if you will. Interesting breakout. We only want to be long if it's above 123. Below 123, leave it alone. Above it, I like it long with a target of 179. And And then this was my favorite of the recent scan is the CNO Financial, simply because, incorporating that top down, we like financials. So when the bottoms up screams out a financial, why not? It's a $4 billion insurance company, CNO. And I like this long only if it's above 26. If it's below 26, leave it alone. Above 26, I like it long with a target of 42. And then Citizens Financial Group, CFG. If CFG is above 48, I like it long. We're right there right now. If we're above 48, I like it long. Below 48, leave it alone. I don't like it. We only like it long if above 48 with a target of 69. Again, all of these names continue to raise their dividends for between 5 and 9 consecutive years and quote unquote, pay us while we make money. And then finally, the Under the Hood report. This is awesome because it's a long short scan that scans for unusual increase in investor interest. It's like, what does that even mean, JC? Well, huge spikes in volume. Somebody's interested. They're buying it for a reason. I don't really care why they're buying it. I just want to know that a bunch of lunatics are now paying attention to this more than they were before. Maybe we want to buy it and jump on that momentum train, or maybe we want to fade them, feed the ducks, and short and take the other side, right? So insider buying, unusual spikes in social media mentions. There's a lot of ways that these get on the list. And like all of them, again, just because they're on the list doesn't mean anything. First, they get on the list, and then we go one by one and hand select the best risk versus reward opportunities on either the long side or the short side. So I know I'm running out of time. I got 2 minutes to see if I can make it. Nature's Sunshine Products, NATR. Currently, the stock is just under 20, which is fine because we only want to be long if it's above 21. So if it's below 21, we want to leave it alone. Above 21, I like it long. This is a small cap. This is a small cap multinational natural health and wellness company. NATR. We only want to be long above 21 with a target of 30. And then Safe Bulkers. This one, as you can imagine, I've been getting asked a lot about the Baltic Dry Index. This is a small cap marine transportation company out of Monaco, believe it or not. I love Monaco, expensive as hell, but awesome, good party. We only want to be long if it's above 4. If it's below 4, leave it alone. We only want to be long if it's above 4 with a target of 11. Finally, Lincoln Electric Holdings, LECO. So this is LECO. Let me just punch it up, get the price currently. LECO. Right now it's around 131.5. I like buying this pullback. We only want to be long LECO if it's above 126.5. If it's not, we don't want to be long. We only want to be long above 126.5 with a target near 180. It's a $7.7 billion global manufacturer of welding products. How about that? So it's a mid-cap stock. Ask all the old timers, they'll tell you the best winners ever come from mid-cap. So those are the minor leaguers, 2 to 100, under the hood, and young aristocrats. We've got a few more, but we don't have time today. But I'm glad that I was able to show you these 4 scans. And by the way, if you're interested in the charts, just email info@allstarcharts.com, but make sure to use the password bottoms up. I give a lot of presentations around the world, and you're going to end up with some Taiwan semiconductor presentation if you give the wrong password. So password bottoms up, email info@allstarcharts for the slides. Boom. How about that? 30 minutes, Rena. How'd I do?
Boom. That was perfect.
Not bad. I didn't think I was going to make it, to be honest.
No, you did great. I'm going to share my screen really quick. Do you want to talk about the masterclass you're doing on Thursday?
Sure.
This guy right here?
About that. So that guy right there, they conned me into doing this master. No, I'm just kidding. Happy to do it. So, today we focused on a bunch of scans, right? This is the bottoms up approach that we do to supplement the top down approach that we're going to talk about. We'll obviously mention the bottoms up stuff because it's all part of, the master class, if you will. The main premise is by the time we identify that we want to buy a stock, let's say Abbott Labs, I'm just making it up, but let's just say 95% of the reason we're buying Abbott Labs has nothing to do with the chart of Abbott Labs, right? It probably has to do with the fact that we like large cap US stocks. It probably has to do with the fact that we like healthcare. Within healthcare, we probably like medical equipment, right? There's probably, of the medical equipment stocks, Abbott Labs is probably near the top in relative strength and positive momentum. And then of all of those, it turns out that Abbott Labs has the best risk versus reward profile to express that particular thesis whatever it may be, my suspicion is if we're buying Abbott Labs, it's probably those things I mentioned. We like stocks long, we like US stocks, we like large caps, we like healthcare, we like medical equipment, et cetera, et cetera, et cetera. And we funnel it all the way down to Abbott Labs is the best way to express that thesis. So I'm going to show you all the tools that we use to do that we then supplement with the bottoms up scans that we talked about today. And that is Thursday's masterclass.
Fantastic. And that's at 11 a.m. Eastern on Thursday. And if you want to learn more, just click courses in the virtual platform or visit moneyshow.com. So thank you, JC, for joining us. I love your energy. It was wonderful this morning.
Thank you.
Absolutely. You have a great day.
You too. Later, guys.
See you Thursday. All right. Thank you, everyone, for joining us virtually today. Don't forget the Money Show will be in Orlando, Florida next month, and we cannot wait to see all your smiling faces in person again. So visit orlandomoneyshow.com to learn more. We're going to have some awesome speakers there, and we look forward to seeing you. Have a great rest of the day.